Thank you very much. It's an honor for me to be here. Thank you for the invitation. My name is Deborah Berebichez, and I'm a physicist turned quant in Wall Street. So today I'm going to talk to you about deciphering the markets and what we can do with data. The first time I heard about data scientists was when I attended the Strata conference a couple of years ago. And there, I attended some talks, and I heard the term data science, and I Googled it, and things like this come up. Just last year, it says data scientist, the hardest job you haven't heard of. If you Google it, you'll also see things like a hot new career. The government has yet to begin tracking the progress of this new career. So frankly, I was a little bit puzzled. I saw at all of these conferences that absent from the conversation of data science were two particular fields close to my heart, but also fields that have been working with data for a very long time. One is physics. And yes, while I saw physicists working in what people refer to as data science, I didn't see physicists talking about how they deal with data in their everyday professions. So for example, just a few things. In astronomy, the Sloan Digital Sky Survey began collecting data in 2000. And it amassed more in a few weeks than in all of the history of astronomy. So it has, right now, it has more than 140 terabytes of information. And when it comes, the successor comes in 2016, it's going to acquire that amount of data in only 5 days. So you can imagine the growth. In particle physics, just the 4 main detectors at the Large Hadron Collider, which probably some of you know is looking for the Higgs boson and so on, produces 13 petabytes of data. Well, that was in 2010. Now it's even more. At CERN, also, we have the compact muon solenoid experiment, which I can explain later. And it analyzes several petabytes of data per second. So to me, that's data science. Also in Wall Street, we have, these are just 2 brief examples, but we have credit card fraud detection systems that deal with, this one in particular, 2.1 billion active accounts, and that's every minute, sometimes every second. They're monitoring all these accounts. Just banks in New York, for example, Bank of America Merrill Lynch, it is known that they use Hadoop, which you're all familiar with the platform, because they have, they're managing petabytes of data, both for regulatory purposes as well as for advanced analytics and trading. So then I said, well, maybe I'm not really understanding what this business of data science is about. So I Googled for the definition. And I liked Hillary and Chris's definition here. It says, we propose one possible taxonomy. What we do with data science is obtain, scrub, explore, model, and interpret. Not only that, but it requires creative decisions and open-mindedness in a scientific context. So I thought, wait a second. We kind of do that in physics already, and we do that in Wall Street as well with our data. So maybe, I don't know, I'm not getting it. And I saw in Wikipedia, similar definition: capture, storage, search, sharing, analyzing, visualization of the data. However, if you look up history of data science, it really comes up as in 1974 when Peter Nur published the Survey of Computational Methods in Sweden, and the term is supposed to be coined or mentioned for the first time as such in 2009 by Nathan Yao. Now, I'm not really concerned about semantics here. It's okay to coin a term and create a new, different profession. But what concerns me is that I think there should be a lot more cross-pollination between fields, and people should share best practices in terms of analyzing data with other industries. And it concerned me that I felt these 2 industries in particular have been working with data in very large scales and analyzing and visualizing it. And I hope that at least I can pitch to you guys that we want to be part of the conversation very, very much. So I thought first maybe size matters. So it turns out it does, because for what people call data science, they tend to have single data sets on the size of tera or petabytes, 10 to the 12, 10 to the 15. But we do have those, both in finance and in physics. So then I read this was the caveat in Wikipedia. It says that these data sets lie beyond the ability of normal software tools to capture, manage, and analyze it within tolerable elapsed times. So I was like, okay, so that's kind of subjective. It's who knows what we can tolerate. And what worries me is that the abundance of data that we have right now is not necessarily giving us better theories. Do we understand more about health, retail, the markets, with all this high-frequency data surrounding us? I'm not sure. And I think, does time really matter? For me, these are sort of the unsung heroes of data science. Tycho Brahe was a Danish astronomer and one of my inspirations for going into physics. And he actually observed the stars without even a telescope in a tower. It did take him 30 years, so some of you may say that's not a tolerable amount of time. But he recorded by hand the daily story of 777 stars. But the outcome of that's about 8 million observations. I think I gave him like a year of rest or so, the poor guy, when I calculated that. But what was the outcome of that was the laws of planetary motion that were later derived by Kepler. So a much smaller data set allowed us to comprehend how the planets operate at an approximate scale. Not bad. Gregor Mendel, in the 1800s, he was a botanist who demonstrated the laws of inheritance. That is, how do we inherit the traits that we have from our parents and grandparents? So he analyzed 300,000 Ps by hand. And he recorded that. That's about 2 million data points recorded without a computer. So I'm just trying to say, so yes, we have a lot more data right now. We're a lot faster and cooler and fancier. But can we produce amazing theories and amazing laws like the ones that we had done when we didn't have as much data? I like this quote. It says, big data, no matter how comprehensive or well analyzed, needs to be complemented by big judgment. And I think nowhere is this more true than in Wall Street. So let me just tell you a brief thing about the ecosystem in Wall Street. This is just a select number of things that people buy, trade, short, and so on to make money, to make profits. So equities are simply a small fractional ownership in a company. Bonds are instruments that are of fixed income, and they're issued by institutions to raise capital, like governments. Normally, they're considered a little safer. Commodities, they're hard and soft. So commodities, soft ones could be something we ingest, like wheat. And you will agree to buy wheat at a later time for a particular price. That's a future. And also hard commodities like gold and metal. Hedge funds are alternative investments available only to a select group of investors. And they can conform all these other instruments in alternative ways. So private equity is when people raise private capital to invest in companies and then improve the company and sell it at a profit. And finally, currency. People also agree on a contract, a future, and they agree to pay a certain amount of dollars for a yen, a Japanese yen, for example, in the future. So that's the ecosystem. So let's talk a little bit about how big data plays in Wall Street. In the US, high frequency, and by high frequency, people mean different things, but that's normally when you trade, you change your trades, anything from the hour all the way to almost nanosecond, which is 10 to the minus 9 of a second, to make profits. So that it's represented, the high frequency people, of course, the infrastructure required is quite expensive, so there's only 2% of the 20,000 firms that are doing that. However, they account for 73% of the equity trading volume. So a large portion of the market is being constantly exchanged hand by hand during these high-frequency algorithms. Algorithm trading is specifically the profession that builds algorithms that have little or no human intervention, and they decide how to trade. Let's say I don't want to influence the market so that the price of the securities I want to buy will not go up in time. So I'll have an algorithm designed to send my orders in batches so that my order is not huge at one point in time so that the price goes up. I love this quote. There's this whole world below 650 milliseconds. It's like landing on another planet, and it really is. Just to give you an idea of the amount of data, there's a new computer chip built exclusively for high-frequency trading, and it can prepare trades in, there's 7 zeros to the left of that 7, okay? That's nanosecond level, 74 nanoseconds. We also have they're building transatlantic speed cables, because now, and there was a great Wired article on it, that people are building cables that can shave off 0.006 seconds on the way for an order from New York to London. We're building them in Chicago. We're building them in other exchange markets. So you can just imagine there's 86 million milliseconds in one day. So if you're trading just at the millisecond level, that's a huge amount of data that you need to account for, analyze, and trade on. So let me talk to you briefly about what I do in this ecosystem. I work for a company called MSCI, and we're known for building both indices as well as for building risk models, which is the area where I work. There are many definitions of risk. We use a simple one, which is measuring the standard deviation of something. So here's a Facebook stock in one day. I think this is a couple of days ago. And if you just look from about 11 a.m. or so, if you look to the past, I just take that window from about 11 to 12, I plot a standard deviation curve, and it's kind of small. I would see the standard deviation of those returns of the price change as how risky the stock is. However, if I move to 2 p.m. and I take a larger window, you see the oscillations are a lot higher in magnitude, so I would see it as a riskier stock. Let's just hold off that in our heads and think that's the way we calculate risk. Our models are predictive. We want to forecast the future, obviously, with errors, and it's not a perfect process, but we want to do it as best as we can. A very naive approach to calculating risk that still some people employ would be simply to look at the time series of all the stocks in the universe. You simply look at, just like the plot I showed from Facebook, for every other stock in the US, and you just plot the standard deviation, and voila. Now, of course, this would be computationally very expensive because, as you probably know, you need n times n minus 1 over 2 data points in time to be able to calculate this risk number. So for example, here for 2 stocks, you see the sigma here is just the weighted sum of the variance of one stock, the variance of the other stock, and their covariance. How are they correlated? How they're moving together or not. Imagine how that formula becomes when you have 100 stocks. That's about 5,000 elements in the sum. Not only that, but it can have spurious correlations, and you can think that something is as risky as something else simply because something happened in one day, but it's not real information. The second level is when CAPM, or the capital asset pricing model, that some of you probably took in economics. I didn't. But I learned, and so it tells us that the return of an asset equals beta, which is this coefficient that measures the magnitude of the movement of that stock with respect to the market. And by the market, we define a collection of stocks, many of them, 2,000, that represent the market of that country. Say the US market would be maybe the S&P would be considered the market, plus an error term, which is this residual return. We at Barra, this is our brand, Barra, we expand this return of the market into many different factors. And this is our livelihood. This very formula right here is what we do every day and what eventually we sell to our clients. So what's the mechanic of the formula? The return of an asset N equals the F's are factor returns, and the X's are just exposures, which means it's a z-score of how exposed I am to a particular industry or factor. So the F sub C is simply the country factor. It's just every stock will be exposed with a 1 if it's within that country. Then we have a sum of exposure. So we have industries. In the case of the US, we have 60 industries. So it can be retail, automobile, information technology, et cetera. And we get the exposure of a particular stock to each one of these industries. Finally, the S stands for style. We have style factors. This theory is based on the fact that we see that that companies with similar characteristics behave in similar ways. So we group these factors, and then we assign a value to their return by performing a cross-sectional regression. So this formula that I just showed before the second one, this is how we do it. This is the mechanics. At the end of the day, we take, or depending on the frequency of the model, we take the return of this estimation universe, 2,000 stocks. So we take, for example, the return of IBM, Google, et cetera. And the return is simply the difference in price between yesterday and today. That's it. Then we know the exposures to the different factors. Here it's 1 to that country because they're all in the US. And for example, the exposure of Google, for example, to size because it is a factor that determines the returns of companies. So the exposure of Google would be around 1.4, which means it's 1.4 standard deviations larger than the average US company. If it was a negative number, it would be smaller than. So we calculate this cross-sectional regression, and we come up with all the Fs in the formula. So all those Fs, the factor returns. Once we have those, then we can express this formula for any stock in the universe. How do we calculate risk? Analogous to what I showed earlier, instead of having a time series of returns, we actually now have a time series of the returns to certain factors that express or explain what are the forces governing the market at a certain period in time. So for example, we have the exposures here on the F. This is what we call the covariance matrix. And then we exponentially weight that in the past to use that. And literally, this is what our clients pay for. They want the data that comes in this covariance matrix to know what the variances of each factor are. How is this industry doing? Is it very volatile? Is it very stable? How is this particular size? Like, are large companies performing better? So things like that are. And of course, as all models, we have to add bells and whistles to make it work even better. So we have 2 novel ideas that we're in the process of patenting, which are a optimization bias adjustment, so you can adjust for under or over forecasting. And then you also have a volatility regime adjustment, which helps you not when you're coming out of a crisis or when you're going into a very highly volatile period, how to adjust for that and the risk numbers not to overshoot what they should be. We have all kinds of models. We have equity, fixed income, commodities, hedge funds, private equity. We even have real-time analytics where people can track tick by tick what our factors are doing during the day, so they know, okay, the first hour momentum factor is not doing very well, but value is, and so on. We have, just on our equity models alone, we have about 600 terabytes of data. And here we have a US model which has 20,000 assets, a global model with 82,000 assets. And of course, because we go back in history, the US model goes back to the 1970s in history. So you can imagine we have billions of exposures. So the US model alone has 73 what we call common market factors that are, and I'm showing here the style factors, things like size, growth, et cetera. So what can we help our clients do? We help them manage the risk. This is one of our softwares, and we help them, for example, know how much of the risk in their portfolio is coming from industry or from currencies, and then we expand that, and you can actually see which industries are your top performers, what is causing the most risk. It can also be used for hedging. Here I have a beautiful hedge. You can see the short and the long positions of a portfolio are almost perfectly hedged, except for if you look at residual volatility, you'll see there's a 1 there. And that means that I have an exposure of 1 to this one factor called residual volatility, and an exposure of 0 to everything else. And you may ask, why would that be useful? If I plot all these factors over time, you can see that some do better than others. Residual volatility was consistently in the last year performing pretty badly. It's this orange one right here going down. So it would be very useful to be able to short that if you predict that that's happening. So we help people create portfolios that have an exposure to a particular industry or style factor. We help tell stories with our data. In this case, we see the US overperforming Japan consistently. We see airlines and banks were both going down and doing badly. However, banks sort of stabilized a little bit until, again, in 2007, they went down. But airlines have consistently underperformed. We see our top performers here in the past month. We see Denmark, Switzerland, of course, Oman went down. This is our bottom 5. We see the value, and we can tell what, in terms of return and risk, how these are doing. And then finally, we can tell stories about the world and what's happening with the market. So here I'm plotting 3 things. These are the volatility of the returns to the countries, the industries, and the styles in our global model. So I'm sure you recognize some peaks. Right about 1998, we had an emerging markets crisis. So you can see it goes up because the volatility of the market went up. That was China, the Russian default. We also have the 2000 tech bubble. But if you see, what went up was the industries, because that was a much more specific industry that created the volatility, information technology. So it didn't really take countries up as much. However, at the very end, we have the 2008 financial crisis. And if you see, pretty much all of them go up, especially countries and industries. Why? Because it was a much more systemic world crisis. It wasn't just one simple industry causing a collapse. So this is all that I have. I hope that at least I've been able to convince you that we are doing interesting stuff, and we're always looking for smart people as well. So thank you very much for your attention.